25% unemployment, 9,000 banks, gone. And in 2002, a Federal Reserve chairman quietly admitted, regarding the Great Depression, we did it. We're very sorry. The institution created to stop banking panics accidentally engineered the worst one in modern history. Not with a single decision, but with a chain of invisible mistakes made in quiet boardrooms, far from the breadlines. How did a handful of central bankers, none of whom ever missed a meal, help create soup kitchens for millions? How did a stock market crash that should have been a nasty recession turn into a decade-long depression? In this episode, you'll see who really had the money in 1929 and why their fear mattered more than everyone else's effort. You'll see how the Federal Reserve slowly turned off the money supply while insisting everything was fine. And you'll see the black swan moments that shattered trust, the stock market crash, the collapse of giant banks, Britain abandoning gold, and finally, the nationwide bank holiday. Let's rewind to the moment the fuse was lit. Picture New York in 1928. Jazz blares from clubs, skyscrapers rise, and in brokerage offices, crowds stare at price boards. The market is up more than 40% in a year. Stories spread of office clerks making fortunes overnight. Only around 1 in 6 American adults owns stock. But that 16% sits on top of everyone else's job. 84% don't own shares, yet their paychecks depend on factories, railroads, and shops financed by those investors. And those investors aren't paying cash. Imagine you walk into a 1920s brokerage with $10. The stock you want costs $100. The broker smiles. Put down your $10. He'll loan you the other $90 with the stock as collateral. If it rises from $100 to $110, you doubled your money. If it falls to $90, your $10 is gone. Drop further and you get the dreaded margin call. Send more cash now, or we sell your stock immediately at whatever price we can get. By 1929, this leverage is everywhere. Margin debt has doubled since mid-decade. Total leveraged positions reach around $8.5 billion, well over $100 billion in today's money. A small group of highly leveraged speculators now sits at the center of the American economy. Plenty of countries have seen speculative manias. That alone didn't guarantee a decade of misery. That took a different spark. One man's death. For more than a decade, American money policy largely came down to a single personality, Benjamin Strong, governor of the New York Federal Reserve. On paper, the U.S. Central Bank was a federation of 12 regional feds loosely supervised from Washington. In practice, Strong was the de facto leader. He believed a central bank should lean against booms and cushion crashes. In the sharp 1920-21 recession, he flooded the system with money at the right moment and stopped it from turning into a full-blown catastrophe. He also understood that money is psychology. If banks believed the Fed would lend in a crisis, they relaxed. If markets believed the central bank stood behind the system, panics calmed. There was a flip side. Strong cared deeply about Europe, especially his friend Montague Norman, governor of the Bank of England. In 1927, to help Britain defend its gold-backed currency, Strong pushed U.S. market interest rates down and bought securities, pouring cheap money into American markets. He later called it a little coup de whiskey to the stock market. That whiskey worked. Easy credit juiced the final delirious leg of the bull market. Strong assumed he could sober everything up later, raise rates carefully, and steer a safe landing. But he never got the chance. On October 16, 1928, after years of fighting tuberculosis, Benjamin Strong died at 56. In an instant, the most experienced crisis manager in global finance vanished. What happens when a system built around one strong personality loses him overnight? Power flowed into a vacuum. In New York, Strong's deputy, George Harrison, took the helm. He was a competent, cautious lawyer, but lacked Strong's authority and instinct. In Washington, an academic on the Federal Reserve Board, Adolph Miller gained influence. Miller detested Wall Street speculation and saw stock gamblers as a moral threat to legitimate trade, farmers and merchants who needed honest credit. Without Strong, the old balance flipped. Washington saw its chance to rein in New York. By early 1929, the stock bubble looked obvious. Harrison and the New York directors had a clear plan. Jack up interest rates, make borrowing more expensive, cool the market, and pop the bubble before it grew deadly. They sent repeated requests to Washington to raise the discount rate to 6%. Between February and May, the board shot them down again and again. Miller and his allies proposed something else: direct pressure. Instead of broadly raising rates, they would lean on individual banks. Letters warned that Fed credit must not support speculation. Bank presidents were quizzed about their loans. If you came to the Fed for help, you could expect scrutiny. In theory, this would starve Wall Street and protect Main Street. In practice, speculative credit just rerouted through non-bank lenders and back channels. Money is fungible. Ban one pipeline, it flows through another. What direct pressure really did was stigmatize using the Fed at all. The discount window, meant as an emergency safety valve, started to look like a confession booth. No bank wanted to be seen there, now or in any future trouble. This was the first part of the Fed's secret mistake. They turned a lifeline into a scarlet letter just as the system was becoming more fragile. So who really had the money? On the surface, it was the 1.5 million Americans owning stock. But the real power sat with commercial banks and, behind them, the Federal Reserve. The Fed decided how much base money existed and at what price banks could get more. Through direct pressure and tightening, the Fed quietly rationed that lifeblood. Between mid-1928 and mid-1929, it sold hundreds of millions of dollars of government securities, pulling cash out of the system. The discount rate climbed, finally hitting 6% in August 1929, just as industrial production had already peaked and started slipping. Think of the economy as a patient coming down with pneumonia. At the first cough, the doctors decide he's been partying too hard and cut off his oxygen. The stock market kept rising, but credit underneath grew thinner, more brittle. Businesses found it harder to roll over loans. Farmers found their banks less generous. The cushion that might have absorbed a shock was quietly shrinking. That shrinking cushion, that deliberate constriction of money, was the invisible debt building beneath the surface. Every time the Fed tightened or scared banks away from borrowing, the real economy effectively borrowed a little from its future stability. As long as confidence held, nothing broke, but the tab kept growing. All it needed was a trigger. October 28, 1929, Black Monday. Selling hits the New York Stock Exchange in a wave. Prices drop around 13% in a single day. Margin calls detonate everywhere. A small-town hardware store owner who dabbled in stocks gets the phone call. Send cash now, or we liquidate your position. He doesn't have it. His broker sells at market, adding to the free fall. That forced sale pushes prices lower, triggering more margin calls on other investors, which trigger more forced sales. It's a chain reaction. The technology meant to keep everyone informed begins to fail. Ticker machines, the clacking devices printing trades on narrow paper ribbons, can't keep up. By midday, the tape is far behind reality. Investors stare at numbers from an hour ago, thinking they're current. A price on the tape reads $150. On the floor, the stock is already far lower. It's like driving on a mountain road using a GPS that shows where the cliff was 5 minutes ago. On October 29th, Black Tuesday, the bottom truly falls out. Over the next 3 years, the Dow will lose about 90% of its peak value. Millions lose savings, hundreds of thousands are ruined. But the crash itself is not yet the Great Depression. Plenty of countries have market crashes without decade-long depressions. What turned this fire into a national inferno was what the central bank failed to do after. A central bank in crisis has one core job: be the lender of last resort. When depositors panic and rush for cash, the bank behind the banks steps in, lends freely, and convinces people their money is safe. In 1930, American banks desperately needed that backstop. Instead, they mostly got words. The invisible tightening that had been building now showed up in the real world through waves of panic. First, in late 1930, a cluster of regional banks failed. In farm towns and small cities, people woke up to locked doors and suspended signs. Confidence eroded. The Fed could have aggressively bought securities, expanded reserves, and drowned the fear. It didn't. Then in December 1930, a huge New York institution with an ironic name, the Bank of United States, collapsed. It was a private bank, not a government entity, but one of the city's largest and heavily used by working-class depositors. If a giant midtown bank could fail, what bank was safe? Crowds lined up outside other banks. People demanded cash and hid it at home. Each individual felt safer holding currency. Altogether, their behavior erased deposits from the system and shrank the money supply. Two more waves followed in 1931 and 1932, especially in the Midwest and West. Banks failed by the hundreds. Some towns ended up with no bank at all. Remember, the Fed controlled base money, but banks created most of the money people actually used through deposits. When a bank failed, those deposits vanished. When people hoarded currency, that cash stopped circulating. By 1933, the total U.S. money supply had fallen by roughly a third. Imagine every third dollar in your town simply disappears. Prices fell, yes, but debts did not. That's the deflationary trap. Your wages drop or vanish. The price of your crops collapses, but the mortgage payment stays fixed. In real terms, you owe more. Households and businesses default. More banks fail. The downward spiral accelerates. Why didn't the Fed slam on the other lever, print money, buy securities, flood the system? Because of an idea. Deep in the institution's culture sat a theory called the real bills doctrine. It sounds technical. Its impact was brutal. Yeah, the doctrine said the Fed should only create money against short-term IOUs tied to real goods moving in trade. In good times, trade is booming, real bills pile up, and the Fed lends plenty. In a slump, shipments and bills shrink, so the doctrine tells the Fed to lend less, right when the economy needs more money to stop a panic. Officials saw fewer eligible assets and told themselves the economy needed less credit. They looked at low nominal interest rates and concluded policy was easy, missing that, with prices falling, real borrowing costs were punishingly high. Layered on top was a harsher belief, captured by Treasury Secretary Andrew Mellon's notorious advice: liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. Let the excesses of the 1920s burn out. Don't interfere. The invisible debt here wasn't just monetary. It was ideological, a bill coming due for the Roaring Decade, paid by millions who had never set foot on Wall Street. And then, in 1931, an external shock turned an American tragedy into a global catastrophe. September 1931. Across the Atlantic, Britain hits the wall. Under intense pressure, the United Kingdom abandons the gold standard. The pound, long the anchor of global finance, is allowed to float and drops in value. Investors glance nervously at the other big pillar, the US dollar. Will America devalue next? If you're a foreign bank or wealthy individual holding dollars, the safe move is clear. You ask for gold, now. Gold begins draining from the Federal Reserve's vaults. For an institution built around gold parity, this feels like a mortal threat. The Fed faces a stark choice. Protect the domestic economy, flood banks with liquidity, cut rates, fight deflation, and risk more gold fleeing the country. Or protect gold, jack up interest rates to lure gold back, even if it strangles already weak banks and businesses. They choose gold. In October 1931, in the depths of a depression, The New York Fed sharply raises its discount rate. In normal times, it might seem modest. In those conditions, it's a chokehold. Gold outflows slow, but inside the country, the internal drain explodes. Depositors, sensing new danger, rush for cash. Banks, already thin, crack under the strain. This moment, defending metal in a vault over jobs and savings on Main Street, is the purest expression of the Fed's secret mistake. From late 1931 into 1932, failures cascade. In parts of the Midwest and West, entire counties are left without a functioning bank. People in local governments pay each other with IOUs and makeshift script because they literally lack currency. Trust in the system, trust in banks, and money itself crumbles. By early 1933, the panic shifts into a new phase. States begin taking matters into their own hands. Governors, watching banks bleed cash every morning, declare statewide bank holidays, temporary closures to stop runs. It starts in industrial states and spreads rapidly. And if banks in the heart of the industrial Midwest can close, why not yours? Within weeks, restrictions on withdrawals and outright closures cover most of the country. By the time Franklin Roosevelt takes the presidential oath on March 4, 1933, banks in the majority of states are either shut or barely functioning. Even the New York Fed, the system's strongest pillar, is near the legal minimum of gold reserves, pinned down by the very rules it once worshipped. The institution created in 1913 to prevent banking suspensions has presided over a near-total shutdown of American banking. That's the black swan that finally breaks trust completely. The realization, at scale, that the backstop isn't there. It took a politician, not a central banker, to reset the game. 2 days after his inauguration, Franklin Delano Roosevelt declared a national bank holiday. All banks everywhere closed by presidential order, but this time, closure wasn't surrender. It was a reset. In emergency session, Congress rushed through the Emergency Banking Act. Federal examiners quickly sorted banks into those sound enough to reopen, those needing support, and those that were hopeless. On March 12th, Roosevelt went on the radio for his first fireside chat. His voice was calm, almost conversational. He explained what had happened, what the government had done, and which banks would be backed. He didn't talk about doctrines or gold flows. He talked about trust and about the government standing behind safe institutions. When the first wave of banks reopened the next day, something astonishing happened. People walked in, not to pull more money out, but to redeposit cash they had hoarded at home. Within a week, banks controlling around 90% of the country's deposits were back in business. The panic reversed, not because the Fed discovered an exotic new tool, but because the government finally offered a clear, credible backstop. Confidence, after years of erosion, got a foothold. Decades later, that earlier failure still haunted central bankers. In 1963, economists Milton Friedman and Anna Schwartz published A Monetary History of the United States. Inside was a controversial claim. The Great Depression was not simply a mysterious collapse of capitalism. It was, in large part, a failure of the Federal Reserve to prevent a brutal contraction of the money supply. In November 2002, at a conference honoring their work, current Fed Governor and future Chair Ben Bernanke stepped to the podium. Regarding the Great Depression, he said directly to Friedman and Schwartz, "You're right, we did it. We're very sorry. But thanks to you, we won't do it again." That was as close to an institutional confession as you are likely to see. In 2008, when a new financial crisis erupted, the same Fed that once tightened into disaster did the opposite. It slashed rates towards zero, lent massively, and expanded its balance sheet by trillions to keep money flowing. Whatever you think of the aftermath, the lesson from the 1930s was clearly on their minds. So when you look back at those black and white photos, men selling apples on street corners, families standing outside locked bank doors, remember what's hidden behind them. This wasn't just the story of greedy speculators and a random crash. It was the story of a central bank that quietly drained the oxygen from the economy, clung to a rigid gold standard, and trusted bad ideas more than the evidence in front of it. It's a reminder that the most dangerous crises aren't always caused by what governments do. Sometimes they're caused by what they refuse to do until it's far too late.